Good morning, good afternoon, everybody. Um, Welcome to the third session of this Model Risk Managers International Association workshop on the move from SR 11.7 to SR 26.2. I'm Alan Forrest. I'm a member of the MRMIA board, and you can probably tell from my accent that I'm quite well qualified for the international perspective or international update aspect of this particular panel. It's clear this SR 26.2 is a very important US regulation, and there's been some excellent commentary and very wise background in the other panels and talks that we've heard. The purpose of this panel is quite different. It's to show that there's a world outside the US in model risk management that has, in the past, taken great inspiration from the US regulation. SR 11.7 kick-started model risk in many parts of the world and continues to be a strong influence. And as SR 26.2 makes a big change in the US, I think it's important to understand what is happening still in the rest of the world, in some sense independently or separately from the US regulations, so that you yourself can compare and note convergences and divergences. So this panel is aiming to, in some senses, avoid one elephant in the room, 26.2 itself. It'll be talking about international regulation for you to compare. It will also be consciously avoiding AI, generative LLM type models as well, to keep it at least to the scope of 26.2, if nothing else. So anyway, enough from myself. I want to introduce very quickly the panel members who are here. First of all, Andrew Mackay, who is a director of AI and model risk lead at Deloitte. Jonathan Schachter, who is CEO of Delta Vega Consultancy and author of a very fine book that I recommend, a first course in model validation and model risk management. And we have Jonathan Taylor, who is Senior Manager in the Quantitative Analysis and Model Risk Management team at the Bank of England. And I hope he'll be joined soon by his colleague, Diederik Potgieter, who's Senior Technical Specialist in the Model Development and Review Division, also at the Bank of England. I should also mention Peter Quell, who's my fellow board member, and Ray Anderson may well join us as well from the MRMIA board to help me if I stumble. Anyway, so welcome everybody. A long introduction, an interesting development in the US, but I've got a general question, and maybe I'll put it first to yourself, Jonathan. Jonathan Taylor, I mean, how are non-US regulators shaping up their approaches to model risk management right now? What is happening in the rest of the world while these changes are happening in the US?
Sure, thanks very much. Can I just check that you can hear me?
Yes.
Fantastic. So yes, I'm Jonathan Taylor. I'm the head of the group that looks after the thing we're not supposed to talk about, which is AI work, but also model risk management. So we in the UK have SS 123, which is our model risk management standard. I guess I should say that you can tell from my accent, I am British actually now, but I'm also American. So before that work at the Bank of England, I was actually the deputy head of CCAR at the Federal Reserve. And I had the privilege of working on the very first SR 11.7 implementation thematic reviews for the top banks in the US. So model risk management is near and dear to my heart. But in terms of the UK, so the UK published a standard as the name implies, SS123, and 3 years ago. And really, the scope of that is the largest banks in the UK, focusing on a principle-based approach to model risk management. So we like to think that we looked out across the rest of the regulatory landscape, the cross-jurisdictional landscape, and updated some of the practices that we had seen firms and other jurisdictions take to this more principle-based approach. And I won't go through the individual principles, but I think a couple of things that are worth calling out. It was really important to us when we issued our new model risk management standards that we not allow them to be too brittle in the face of the way in which models and technology was being applied in institutions. And one of the ways we did that was by shifting the emphasis on from validation up front that we could sort of think about for traditional models, but instead focusing on the different aspects of the model lifecycle and encouraging or asking firms to identify the controls that are most appropriate for the model or the system that they were using. And we do think that's quite flexible approach. So there, of course, I should say models sometimes get a bad rap nowadays because everyone's talking about things like agentic AI and Gen AI and things like that, which are also very important. But we still have models. It's important we identify and control them appropriately. So we shouldn't lose sight of that. But I think is important to not just get the upfront bit right, but the ongoing monitoring and the performance testing right. So one of the things that we point out in our guidance is this emphasis towards how are you identifying the guardrails for your traditional models and what's the relative emphasis you're placing on the different parts of the life cycle. Again, we think that actually extends quite well to some of the hotter topics that some of the other jurisdictions have recently excluded from their guidance. The other thing that we've emphasized is board oversight, and that's not surprising, I think, for a jurisdiction. For I think all jurisdictions hope to have good governance and board and senior executive oversight. But one of the things that we've been focusing on more recently, and I'll end with this, is how do we measure model risk? This is a discussion that I remember having when we issued stress testing model risk standards in 2018. I remember having that discussion when we were talking about 11.7 implementation at the Fed. And I think there's a real range of discussion here. Sort of on the one hand, and I think most firms do this, identifying metrics or KRIs that are very compliance oriented. So have we validated all the models? What's the aging of the issues? What's the severity of the issue is, and so on. I guess sometimes when I'm talking to practitioners, we kind of go to the other end of the spectrum where we talk about, well, it's impossible to, but ideal. There's some sort of platonic ideal we'd love to get to, but we can't, which is a single model risk metric to rule them all, to mix my metaphors. But we think there's somewhere in the middle. If we've identified appropriate model performance thresholds, then that is a really neat way that can feed into identifying which models or classes of models are having particular issues based on how we're measuring that ongoing performance. So we've really been emphasizing to senior executives and the boards in the UK this importance of, yes, beginning with these KRIs that are important, but more compliance related, and yet moving towards something that's a little bit more quantitative based and a bit more focused on the inherent risk that the models are representing. Thanks.
Okay, no, that's very interesting. So the UK regulation, I would say, is maturing rapidly, and maybe even innovating. I don't know, Jonathan Schachter, I might turn to yourself for
Sure. Yeah.
Your understanding and views perhaps of other regulators and how model risk management is maturing and innovating where you see it.
Alan, thanks for marketing our book a little bit. I appreciate that. Indeed, Appendix B of the book, we looked at a total of 8 jurisdictions, the US, the UK, and 6 others, and how they did model risk. So I'm going to talk a little bit about that. This is a survey that we did in 2024, but there are 2 ways I think to look at it. One of them is scope, because well, first of all, what's the straw person? The straw person is you're either a global bank that is, let's say, in the US plus, and so then you also have to be in these other jurisdictions. I think there'll be more later about that. Or you're newly going to this country and you want to understand how to do MRM there. So there's an issue of scope, and then there's an issue of yeah, and there's an issue of sort of the scope of what the actual regulator does. So just to run through, I divided them into broad, medium, and narrow scope. The broad countries then were the US, the UK, and the Central Bank of UAE. The medium ones, Canada and Japan, and the more narrow ones, Hong Kong, Europe in general, Singapore, and India. India actually wasn't in the book, but I've looked at it recently. We can start there. India basically is just a very short document on credit risk models. The other narrow ones, let me take care of those. I told you the broad ones at the top. Hong Kong just as market risk. And Europe, 2 things. Market risk is one of them. The other one is credit, but they specifically mean ratings and counterparty risk. And Singapore is pure AI, including Gen AI. May talk about that later if I have a chance. What medium means is, well, for Japan, what it means is they took SR 11.7, it seems, and just took the sort of the parts of it that they liked, and they created a document. Of course, there are issues of language and so on, but it looks very similar to a lot of 11.7. In the case of Canada, which small country, but they regulate everything from soup to nuts. Credit rate, credit what's the word? Credit unions, sorry. Insurance companies, they have 5 large banks, so on and so forth. I think we know North America pretty well. But they had some interesting things that I would say are outside the standard things that one would see in SS 123 and 11.7, like data standards and what they call particular validation activities. They also have recommendations on how to decommission a model, what's the best way to modify a model. But one thing in the OSFI guidance is that independence is not really a strong theme, which may reflect their very broad mandate to go to credit unions. I went to a Toronto conference recently. We did talk about OSFI E23, and in many situations, it's really peer reviews. It is not independent model review. We had a TD, Toronto, biggest bank in Canada, one of the bigger ones, and then a credit union from Vancouver, from the West Coast. It was very different in terms of the models they see and also in terms of independence. So I think uh, all of this gives you a flavor of the types of different things that you would see in the same way that you would do different things between, let's say, Scotland, Wales, Northern Ireland, the UK, and then even, going to Ireland proper. So there are these regional differences. Many of them do seem to reflect themes, if not purely in SR 11.7, then in a kind of the SR 11 kind of inertia that I may talk about later, that is like in Newton's first law, seems to be there. It's a hard thing to change. There are some ways and some people who are trying to change it. And we might not, I don't think I mentioned the document name, but there may be a little bit of American exceptionalism going on out there. Or let's say one could imagine that the current document is something like if the US were originally on the metric system, now it's decided to go straight with foot, inches, and Fahrenheit. But the rest of the world will probably still stay on the metric system and may likely stay on the themes that the Fed originally espoused, even if the Fed no longer is so strongly pushing them.
Okay, that's interesting. So you foresee a potential divergence. We'll come to that point later in the
Yeah,
in the panel, but this is interesting. A, you said the UAE was particularly strong
right.
on SR11 7 basis. Could you expand on that just for a few, 30 seconds a minute?
Yeah, I might need to crib my notes over here, but the it's a fairly it's called model management standards. And so, some of that is the risk, some of that I guess might be the governance and things like this. I didn't, I've prepared a lot of things. I didn't have that exactly at my fingertips, if you don't
Don't worry,
mind.
Jonathan.
No, I'll read right from the book. For example, effective challenge is there, but it's a slightly different definition of a effective challenge. Number
Okay,
two is instead of performance monitoring, they call something model performance monitoring, which is a bit different. So it's what it specifically is a kind of triggered by exogenous changes. A Middle East war, a big hurricane in New York City. So it's sort of you don't do it. I should step back. Model performance monitoring in SR11.7, and the way I've seen it in New York is like quarterly. You're worried about a model, so quarterly you have to run a few tests and log them, and then someone looks back at them, and that's an evaluation of how the model is going. The my understanding of the PRA standards are relatively similar. Um, there's also a different understanding of model risk from CBUAE. I'm just taking quotes right out of the appendix here. They
so
give us specific spreadsheet guidance, and again, they're a little bit more hands-on in terms of the steps in the validation process.
okay,
So yeah,
so there are definite unique features there as well. Andrew,
Yeah.
you also have experience with international regulations as well.
Yes.
Very interested to hear about that and your background there.
Yeah, sure. Yeah, thanks for inviting us, Alan. Good morning, afternoon, evening, all. I'll quickly pick up on that UAE point, just because I was at a conference in Paris yesterday where an old mutual friend of ours actually is now working in the UAE and informed me that the scope of the models they're quite heavy on credit, IRBB, so the NII and Delta EV models, but also fin crime models. Big, quite a long, strong, which hadn't picked up in my reading of they're called the model management standards, but apparently that's a key area and a key focus for them. So yeah, I'm Andrew Mackay. I've spent nearly 20 years in working in model risk management, 16 years plus in industry at RBS and NatWest with Alan and many other good people, and then a few years at Deutsche Bank. And I spent the past three as a director at Deloitte, helping clients across financial services, sometimes beyond, build from scratch, update or enhance their model risk frameworks, and increasingly to incorporate AI or build out AI risk frameworks. Um, I mean, let's not pretend you didn't send the question out before. So I obviously have a similar answer to Jonathan S's, but I will try and I'll give you my take on it, which is that yes, we have. I think historically we're on a similar trend in terms of intention, but there's always been some variation in scope and application. Would be in a sentence for me. The US. I think it's important to note that we had SR 11.7, but I think the big change was the OCC handbook. I mean, maybe that for those on the outside looking in, maybe the OCC handbook reflected where the regulators had interpreted SR 11.7, but it suddenly made it a lot more of a checklist exercise. And that was certainly the way it seemed to be interpreted. So I think the OCC handbook of 2021 was a key document in the sort of storyline here. Um, Japan, yes, FSA's principles on model risk management, all encompassing but pretty light. But to me, they seem to be limited in their enforcement. So I think that's a key difference from what I've seen, just experience. The EU always focused on capital models. Um, but even within the EU, actually, Germany itself has expanded MARISK in the last few years. So if you check out 435 of MARISK, that talks explicitly to managing model risk beyond just the capital models. Um, Singapore, I think I agree on that one. Yeah, has always been a leader in AI MRM documents, and maybe there's something more to come on there. Canada, yeah, I'd give E23 a bit more kudos. I think it's a good document. I think it's quite thorough. But it, yes, very interestingly applies to all financial services, not just banks. Um, and then back on UK. So obviously we have SS 123, and Jonathan T touched on the point that the board is a focus there. What was the other aspect? It was about metrics and KPIs. I think I could come on to that. I've got a good point on that. But yes, SS 123. But I think another key difference in the UK, away from the details that I'm undoubtedly going to discuss with Jonathan on the call, sort of beyond proportionality, allowing something to be a model in the inventory, but not necessarily fully validated the same. But apart from those details, it's how SS 123 for me explicitly ties into other regulations, such as the SM and CF, so senior managers and control functions regulations, which enforces an individual accountability regime. And when you listen to all the chat and noise about AI regulations, it's something that keeps coming up, and I think it's something other industries would do well to copy. Um, so for those not familiar with SM and CF, fair enough if you're not in the UK, I think you can probably guess what individual accountability regime means, though. What it translates into is, though, a clear single person who is accountable for making sure that reasonable steps have been taken to ensure there is a proportionate and appropriate model risk framework embedded across the firm. Uh, Jonathan T, feel free to correct me if my language wasn't quite right in the interpretation there. But that person is typically a CRO. And I think that's the key difference here. With SM, yeah, with SM, with this individual accountability regime, it does make it a lot easier and a lot more effective to implement the aspects of the framework that I think other countries. That would be if I was suddenly magically in charge of another country's regulation. I think that's where I'd go. That's what I'd try and push for. I imagine it's very hard to get in without the momentum of something like 2008 behind you. Inertia, sorry. Or which one is it, Jonathan? I can't remember.
No, all good points. So yes, the the individual accountability of a person seems to me to be um, an important point that is not universal among all regulators. May even be unique to the UK regulation. A Jonathan, not to put you on the spot, but do you see this as a true innovation of the SS 123? Did its inspiration has it become an important anchor point of the regulation, a useful thing in its implementation?
I think so. I think there's sort of two things that I think are really helpful with SS 123 in this regard. So the first one is, of course, having a single person, or possibly more than one single person, actually. So we sort of provide for multiple senior managers. Usually that's not more than two or so. Often it's one. But there's a clear accountability. That's really important for the firm and to us to ensure that reasonable steps have been taken, as has been said. But I think if there's sort of the single accountability in a firm, there's also sort of a modular approach to the controls that you would construct across the system of risks that you're trying to understand. So what that means is SS 123 is quite broad in its principles and it tried to be future proof, and it captures, I think, I'll stick with my jurisdiction. We capture lots of different sorts of technologies because of that. But we're quite conscious that model risk is a very important lever, but it's not the only lever in many applications. And so it's important to us to have broad model risk management principles, but for those to link together quite clearly with our other regulation on third-party risk, for example, or our other guidance related to data. So we think there's different approaches. We can come on to this, but there's different approaches jurisdictions can take. You can have one guidance that tries to wrap everything together, or you can have different bits of guidance that can be applied to the different aspects of the system or the problem that you're trying to control, including the model component. and we are quite consciously trying to use that component approach to deal with and be as flexible as we can be to the evolution in model technology.
Okay, that makes sense. Um, Jonathan S., I'm wondering if we could move on to one of the obvious questions that arises from this variety of regulation.
Right.
How is it that an international bank who could have a footprint in the US and in the UK and in Japan and a lot of other places, how what's the way to reconcile this? Is it simply super equivalent? And so big US banks have to be as good as everywhere else? Or is it something more in between?
Yeah, I mean, the bottom line, well, we could talk about three kinds. We could talk about a US-based bank, the biggest ones, which also want to be in London and they want to be in UAE and things like that. And so there the question is a lot, I think what I said before, how much of the sort of this inertia of SR 11.7 or whatever you want to call the existing model risk framework is there so that if just the US perturbs, then they're still have to go through London and so on and so forth. So I think not much changes. At the other extreme, you have small banks, say Silicon Valley Bank, which are purely U.S. In fact, just take a minute. There are three levels of regulation of MRM in the U.S. Silicon Valley Bank is the FDIC, right, which is on the new guidance, but they're a lot smaller and there's a lot different. In between is the OCC, which someone else mentioned. So now we have all three U.S. regulators. Um, and so, the types of things we're seeing in there is, how is the model defined? Um, how is effective challenge? Things like that across the different jurisdictions. As noted before, there aren't a lot of huge differences. So I think for a JP Morgan or something like that, you could actually eliminate SR 11.7 and have no model risk guidance at all in the US, but they still would pretty much look the way that they do now. The inertia, you need a pretty big force to change the way that their global MRM would be.
Okay. So, Andrew, do you have an insight there? You have a client who's an international bank. Would you encourage 26.2 and the other regulations? How would you advise them to envelop these successfully?
Yeah, I'm intrigued to see what happens next. So I agree with Jonathan S on the super equivalent on the fact the big US banks they will they change what they do. I mean I think so, something we've seen in the UK is I think historically we used to have three tiers of models: high, medium, and low. For anybody working in model risk management about 10, 15 years ago, that was pretty standard. Um, then in the UK, SS318 talked about highest, sort of very high materiality models, the board having a good understanding of the most material models in your bank. So a lot of banks sliced out a tier one out of the high. Then we realized that everything had to be in scope of MRM, but you wanted to treat some things very differently. So there was a tier five where it's sort of in the UK, I think a lot of firms have a tier five bucket where it's in scope of MRM, so it goes in the inventory, but the validation could be, I mean, I would argue it's sensible for it to be as little as just confirm it's tier five, just confirm it's not material. Um, Perhaps that will be the change you see in the big US banks. Maybe they will adopt a similar approach. Maybe they won't do repeated annual reviews. Because again, in UK and Europe and the big banks, we actually see a switch more to instead of annual revalidation, it's every 2 years because then you actually see the wood for the trees. In that year in between, you might do something else. So I think there will be some changes. I agree, broadly speaking, Jonathan Ness. I don't think they're going to change. Like I say, JP Morgan, Goldman Sachs. I don't see them moving too much, but I think there will be some changes. However, I have also heard big US banks happily say that the easiest approach is just to adopt the country of the highest standards. Yes, super equivalence. I think that was very easy for them to say when that was SR 11.7. Um, if the highest standards are now not in the US, if they are, say, E23 or SS 123, well, I'm intrigued to see if they will adopt the same mentality and say, yes, we should just adopt the highest standards across the globe. We'll see. I
Okay.
suspect not. We'll see.
Okay,
Um,
that makes sense.
yeah.
I mean, Jonathan, again, not to put you on the spot, but the regulators must be looking out for inequivalences, converges and divergences. Without commenting on any other jurisdiction but your own, can you nevertheless talk about how you might resolve inconsistencies or look for equivalences?
I think you said Jonathan, but might not have qualified it with the
Oh,
last
so
name.
Jonathan T, I meant, of course.
Right. Sure. So I'll take a stab at that. Um, so look, I mean, each jurisdiction in the end is parochial. So in the end, we look at the firms operating in our jurisdiction. We've issued a standard, and they need to adhere to that standard. So that's there's not really any doubt about that. I think it, without commenting on specific jurisdictions, I do think the arc of model risk management is actually fairly clear and fairly unified across jurisdictions. I think the movement towards more principle-based model risk standards, the movement towards more flexible applications across the model lifecycle to achieve the appropriate validation, independent review, and controls. I think that's also quite clearly the case. It is the case that different jurisdictions have approached generative and agentic AI in different ways. So some have expectations that are all encompassing, some do not. But I think that in most cases, even where jurisdictions don't explicitly deal with a particular technology, there's a constellation of policies and principles that are intended to be applied flexibly. And I think that that's so. So I guess what would I say about divergence? Of course, there will be divergence. It's for any organization to decide how best to deal with that. I think my own observation so far is that even in instances in my jurisdiction, where SS 123 is more exacting for large international banks, it has tended to be the case that those international banks have adopted their global strategies to meet that particular requirement. Not all, though, have done that. And it's not our expectation that firms take one approach or another. But I guess I want to sound on a slightly hopeful, if not too overly optimistic note. I mean, we're talking about instruments and technologies that are incredibly powerful and incredibly helpful and also often incredibly uncertain. And it's in our collective best interest to deal with those technologies in a way that allows them to be industrialized safely. And I guess my own view, which is not surprising, is that you do that best by articulating clearly the framework that you want to use, and having done that, industrializing quite rapidly. I think it's a false economy, and I think we can probably all think of quite a lot of examples in history quite recently where the move to adopt innovation without setting out that framework in the first instance has ended quite badly for the industry. And I think that at most institutions, there's enough of an institutional memory that, of course, institutions are motivated by different things than regulators are. But I think, if anything, the risk-adjusted motivation will drive kind of the continued arc of model risk that I see.
Okay, no, that's optimistic, I think, even. But clearly, one of the key, the elephant in the room, or one of the elephants in our room, was the AI and generative AI and large language models, and that is going to be um, a big event. And in the US, we're promised a regulatory release later this year. Singapore, you say, Jonathan, has already got its act together on this. I'm just wondering, maybe in 2 minutes each, we could comment on the prospects for model risk management, perhaps with a particular touch towards AI. Um, is the world going to converge on a single approach to AI, MRM, or is it going to explode into a variety of industries? Jonathan S., I'm just wondering if you have a thought or a comment there first.
Yeah, for example, if you do look at Monetary Authority of Singapore, it's interesting because it takes like some of the 11.7 concepts, like arguably when it talks about robustness and stability of AI, that is based on things like sensitivity analysis, stress testing, things like that, sort of more traditional things. Another area is reproducibility, which is, I would argue, just a kind of outcomes analysis. Um, what some people call backtesting, but as explained in the book, I don't like the word backtesting. Um, but um, but I think, you also you're right to kind of have this caution or this conditional approval of what the situation is now, because when Gen AI and agentic AI guidance comes out, if it does from the Fed, then we may have to move the chess pieces around a little bit to understand. Yeah.
Andrew, can you add to that? Where do you see MRM the same in 5 or 10 years' time?
10 years' time. I mean, a decade in terms of predicting the future is a lot longer than it was a decade ago. You know what I mean? Um, uh, yeah, so in terms of, there will be divergence, there will be some, but I think some divergence is healthy. I think we're broadly all in the same spirit, but again, we're sort of, there's a tendency now more towards focusing on the user of the outputs. There's a tendency more to think of model risk, less of the methodology, the specification risk, and more around the use risk, which again is a good. I think these are all good things. Um, but that diversity is healthy, and so different regulators will come up with different things. So Hong Kong went as far as to state, and I wrote this one down because I wanted to quote it in case we get it wrong. The scope of model validation should cover testing the effectiveness of the cybersecurity and data risk management controls in relation to the AILM. That's an interesting one. They wrote that a couple of years ago. I haven't seen anybody copy that. Perhaps that went too far. Perhaps that's not something you copy. But there are other things that we see regulators put in that they do choose to copy. So the PRA's approach to post-model adjustments. So making sure if somebody overrides the output of a model, they do it because it's linked to a limitation, which is linked to a fundamental weakness in the model that can then be adjusted for. And you see the EU did actually sort of copy this for IFRS 9 models. They put in some extra guidance around post-model adjustments for IFRS 9 models. So I think hopefully we see this, well, as a consultant, I always like to see some divergence in regulations. um, but hopefully that divergence, though, leads to good ideas. And yes, we look forward to, I think Michelle Bowman said the guidance on Gen AI is coming out in Q3. I suspect it's going to be more like Q4, but we'll see. We're looking forward to it.
Yeah, that's good. And Jonathan T, uh, divergence or convergence, how are you keeping abreast with the other regulators in the world? How are you? How do you see model risk management developing as a regulatory effort?
So I think, well, first of all, it's important to say the international jurisdictions meet quite frequently, discuss kind of what we're seeing in our respective institutions and jurisdictions. So it's not. I don't think it's often the case that there's divergence for the sake of it. So if there's divergence, then that's going to be because of some jurisdictional specific issue. We're quite conscious, though, that in the end, we're trying to control risks as the foundation to allow firms to do and operate in the businesses that they do. So I guess I'm relatively optimistic about sharp divergence emerging. But I think that inevitably there's sort of specific issues that will arise. I think in terms of the future of MRM, I think it's a really interesting question and one that I don't have the answer for, but something that I've observed though, and I think is again perhaps more hopeful than a regulator ought to be. Um, for a long time, we've been talking with firms about the importance of getting the upfront validation right, but shifting that focus to the ongoing testing and performance monitoring, taking sort of outcomes that are very sort of static and compliance focused, and instead moving towards more dynamic and risk-based measures to identify their risk appetite around, or to form the risk appetite around. And I suppose a lot of the conversations that I'm in, I guess half my time, actually probably less than half my time, is now spent talking in model risk management conferences, and 75% is talking in AI governance conferences. I think a lot of the discussion rightly is focused on the life cycle, the outcomes, and the risk caused by the uncertainty of the outputs and how you deal with that. And I think that is something that most model risk managers and certainly most jurisdictions have been talking about with respect to model risk management. So I guess my hope is that the principles are sufficiently flexible, but the emerging technology will force a little bit of a recalibration towards some of the other elements of the life cycle and the inherent uncertainty that through different tools we've been trying to affect in our respective jurisdictions.
Okay. No, again, optimistic, and bringing in a lot of some of the vocabulary of 26.2 as well in that sense. So I can see a spiritual convergence, perhaps, of the regulations over time. Jonathan S., perhaps as a last word, uh, as a writer, perhaps science fiction writer, how would you position model risk management in 10 years? Do you see it as a component, small component of a big risk organization, or do you see it as a principal risk growing and emerging?
I think that without AI, it would be a lot easier to tell. AI seems to be a random variable. I totally support what Jonathan said, that AI governance, which we didn't speak very much about, is definitely an interest of mine. And the biggest issue I'm concerned about is Gen AI being used by hedge funds, which are outside Fed scope, outside all regulatory scope in the US. Essentially like driving a car without guardrails and so on. So that's what I worry about. I hope that AI. I wish they'd focused on AI first and then maybe changed everything else, because that's my big concern. But on the other hand, we've proposed some solutions for AI governance. One of them is to have scorecards of all the models using things like BLA and movers distance and things like that. Truth score. So let's say if you are a hedge fund with 1 million LLMs, you can see the things that may hallucinate before they hallucinate. It's the check engine light on the dashboard or the gas gauge or the petrol gauge, whatever, and oil and things like that. That's what I think we need, something like that. And so if that were in place, I would sleep a lot better in 10 years.
Okay, no, that's well. Let's hope, and that seems a good point at which to break off. Thank you very much indeed, Andrew, Jonathan.